Good afternoon, fellow option traders. This is Jeff. This video, we're going to talk about the update to the Profit Tent portfolio, which currently has an expiration date, most of the options anyway, of November of 2012. And this is just an update of what's been going on and what has happened to it over the last week. You can see that this old guy is pretty happy because we're sitting right now with a profit of $412 on $10,000 worth of risk. Not bad, little less than 5% in a week, not bad at all. But can this continue? Well, we don't know. The other good thing that we're looking at right now is we have a delta of minus 65. A little bit on the hot side, meaning that if the stock continues to go up, our delta is going to continue to go up, and therefore our theta will be reduced a little bit. You know, if we have delta right around zero or as close to zero as possible, it's going to maximize our theta, which is currently at 25. But in reality, you know, I was watching this last week and it was telling me theta was 25 and it was making $50, $54, $55 a day. Obviously, because it's up $412 in 5 days, so it's doing better than $25 a day. So what should I do? Well, I got a little worried last week when I got a comment from one of the readers about my Vega number here. I have a lot of negative Vega, which means if the market goes down and volatility goes up, and those two things usually happen hand in hand, then we could be in some deep doo-doo. And let me just show you quickly. We'll come down here and we will click on this little wrench and we'll add 5 points to our volatility. Just a measly little 05. Right now, overall we are at, on the stock, a volatility of 15% roughly. We're going to change that to 5, press the enter key, and we jump up to 20.5. Our current profit line, the white line here, drops down to minus 945. That's a little worrisome to me, which tells me that quite possibly if the price of the Qs drops down to 69, we could end up with a little bit of a pop in volatility, and maybe even as small as 2 is going to wipe everything out that we worked so hard for, and actually put us a little bit underneath. But if it goes down to 69, well, then it would be right around minus $400. So that's a worry for me. Another thing, let me reset that. Another thing that worries me is this. If we look at it, let's go to a chart. This is a daily. Let me change it to a weekly. All right, did you see this line that I have drawn in here at 60? You can see that it was resistance here, resistance here, resistance here, resistance here. So last year it acted as resistance, that area anyway, 4 times before it finally broke out in the beginning of this year. Stock ran up, came down, support at 60. Runs back up. Yeah. Is it going to come back down and hit the support level? And if it does do something like that, and there's a lot of talk about people being worried about flash crashes and black swans, people always worry about that, but when the market seems to be overextended, and looking at a stochastic, it's definitely been overextended for a while here. It was overextended here too, pulled back a little bit, came down to that 60 level, and now it's back up, and it's overextended, oversold, according to my stochastic, the way that I track it. So there's a little bit of a worry there. So thinking about that, what I did was I just went out and I bought some 60 puts just for some protection. And I actually entered the order as a calendar, and it was at my 60 strike for my short 60 strike. And when I did that, I ended up buying them back. So I don't have anything down here actually at the 60 anymore, except for these 5 long puts. And here's what these 5 long puts are going to do for me. And let me just use this as an example. I'll reset the parameters here. We'll get back to 0. Skew and volatility. Uncheck QQQ, and that unchecks everything here. We'll go back down here and we'll check this 60 put. Now we won't pay much attention to the white line, which is the current price as of this date, but let's take a look at the red line. If the stock should come down to 60 or 59 or somewhere, well, actually we are going to pay attention to the white line. And our volatility increases like we were talking. If it goes up 10 points and it drops down to 60, and let's say that happens 2 weeks from now, so we'll go into October and let's just say the 15th. If it drops down to 60, that's going to give me about almost $1,600 in profit. As you can see by this is the current date, which is 10/15 down here. And the white line is up here around 1,600 if it drops down to that support level at 60, if. And that's only an if. This whole trade, all 5 of these puts, cost me only $105. These 5 down here only cost $105. So it was definitely worth it. So there is some protection here. Now let's go back and look at the whole thing again. What's going to happen if reset the parameters? What's going to happen if it drops down, say down to this 69 number, and I do get an increase in volatility? Well, I have to make some sort of decision then, whether I think it's going to continue or if it's going to come back up to where it is now. It's just a temporary pullback, or is it something more serious than that? That's part of the game, I guess you might say. Normally, in the way that David Valieri recommends adjusting these, for me, if I'm worried about it dropping, then I would sell the Qs, but I can't do that because I'm trading in an IRA, so I can't short a stock in an IRA. The only thing that I could do possibly is to do some sort of spreads or buy some puts at the money or slightly in the money to help protect this if I wanted to stay in it. It's very tempting, if the market doesn't move Monday or Tuesday, to just close this whole thing down, but I'll hang on to this put. I'll hang on to the December 60 put, but I may just bail out of this thing. If I get another $50 a day next week and the market just sits there and spins its wheels, then it's going to be very tempting to get out. But if the market continues to drift upwards, the way to adjust this, if you're getting too many negative deltas, is to buy stock. So for every share of stock, you're going to add 1 delta to this total of minus 65. So if we get up over 100, theoretically, if I buy 100 shares of stock, I'll cut 100 deltas off of this. Let me show you that. go to Add Simulated Trade, and we'll click on the Ask, and we'll come over here, and we have added 100 shares of stock to this. And we are now positive 34 deltas, whereas before we were negative. Is that correct? Yes, we were negative 65, add 100 shares of the stock, and we're positive 34, and we continue to maximize our delta, even as the stock moves up. And the delta really stays at 25 or more. It actually goes up to 26 at around 71, and then it starts to peel back a little bit as it starts going up. But that's the idea that we want to do here, is we want to keep this delta pumped as high as possible for as many days as we can. So that'll be the easy part. If it drifts upwards, and I will do this adjustment, I will stay in the trade if it drifts up, and I will do this adjustment if we get up around 150 deltas or more. I won't do it before because I just don't want to, I don't want to do an adjustment unless I have to, and that would be kind of a pricey adjustment. Yeah, that would be kind of pricey. That's $7,000 to buy 100 shares, so I have to think carefully about that. But it's good to have that kind of money in your account so that you can do that to make your adjustment. You don't want to put too much into this because you need some money on the sideline in order to do the adjustments. Alright, so that's my update. Thank you for watching, and happy trading.